What's up, my fellow traders? How are you today? I hope you're doing very well. Welcome to our new stock alert of this week. So in this video you will see a full analysis of the hottest stocks to buy right now that can grow up to 500% in the short term. So let's get into this. Okay, now the stocks in question here are mainly Royal Caribbean, Norwegian Cruises, and MGM Resorts. I know these stocks has been plummeting in the last months and all kind of bad news has been floating the internet, but that's what I love the most about these stocks. Here's why. So to prove my point, let's get started with Royal Caribbean. Now I'm gonna walk you through the key fundamental ratios deployed in time, and then we're going through the technical analysis. All right. So I separated the key ratios in 4 groups: earnings, valuation, management, and technical analysis. So the first group that we're gonna analyze is earnings. So let's take a look at the earnings of the company in the last 5 years. It's been crushing all the expectations, and the earnings growth year over year has surpassed the 20% every year. Besides, we're talking about a mid-cap company that were worth around $30 billion. Now it's under 7.5 billion. So this kind of EPS growth is not very common, even more in this industry. In the next chart, we see the EPS grow quarter over quarter. And what captured the most of my attention is how they've been consistently growing earnings compared to the same quarter the prior year. So we can compare them and see that the tops and bottoms in the chart, all right, I'm going to point it out. The tops and bottoms of the chart, yes, on the earnings quarter over quarter, has been overperforming each other by 7% or even more. That's something that only micro and small caps are more expected to do. So that's a great signal about the performance of the company. Okay, now let's move on to the next ratio. Okay, and what we can take from this graph is how the market cap, that is the line in blue, has been trading above earnings growth, that is the green line, from the beginning of the 2016 until mid 2018. Well, then the EPS has been growing steadily while the price has started to move around below its earning growth, as we can see. As we can see here, right? So this is a clear signal that the stock is getting cheaper. Okay, in this graph I want to point out how the price has been doing during the high and low EPS quarters. We can see here a kind of a seasonality where the prices drop on April when the earnings are low. I'm going to use the red point. Here we can see how the price drops, and then it goes back to make new highs on September here when the earnings are up again. Okay, at the end of the chart we can see the overreaction of the market. See here, the overreaction of the market due to the recent crisis caused by coronavirus. So the market here is reacting out of fear and uncertainty, and that's when we have to become greedy. Okay, this tells us how undervalued is the market right now. So that's when we can spot the best opportunities to make money. Okay, so the next one is one of my favorite ratios and tells us the ability of the company to convert their earnings into cash. This ratio tells us the real profitability of the company, and its name is cash from operations. Okay, so why is it the real profit of the company? Because this is the cash that the company gets out of their commercial activities. Okay, in this case selling cruises, packages, and so forth. So this ratio shows us how successful the company actually is, and it's really curious how barely few traders out there use it. So in this chart we can see how Royal Caribbean has been able to convert their earnings into fresh growing cash over the years. Okay, we can see a strong uptrend where the cash from operation has been growing, and now they held around 50% of their market cap in operating cash. So that is something that is not very common in white non-stocks as Royal Caribbean. So this is a reason to add up that the company is undervalued, that the prices don't reflect its real worth. So we saw here the different ratios and metrics around earnings, and we can see how they're growing, how they're strong. So we're gonna give earnings a 5-star rating. Okay, now let's move on to valuation ratios. Okay, so we're not gonna spend so much time here because these valuation ratios are well known, and probably most of you know them very well. If you don't know what it actually means, P ratio, PS ratio, price to sale ratio, or price to book ratio, you can search for it in Google, just typing for example P ratio or PS ratio Investopedia in Google, and that's a really good source. So we're gonna step on this ratio, the P ratio, and this shows us how cheap the stock has become in the last month, and how only we have to spend $3.88 to get $1 of their earnings. So to put it more bluntly, it would only take 3.88 years, almost 4 years, to recover our investment. That's a really great hint that the company is getting cheaper. As we can see here, a downtrend, we're going to point it out, a downtrend in the PE ratio. So we can see in the last that in the last 5 years the company is getting cheaper and cheaper, because as we can see, as we saw in the previous charts, the earnings has been growing steadily, while the price has underperformed the earnings growth. Okay, and now we can see here in the last month the P ratio plummeted. So that means that the company is getting really cheap. So now the PEG ratio here tells us how the earnings growth has been outperforming the P ratio. So to add up to the cheap stock, the PEG shows us that it may get cheaper. Here we can see, we can see that the PEG ratio has been plummeting. Okay, and now it's down 1. When it's down 1, that's what we're expecting to see. When the PEG ratio falls below 1, it tells us that the stock is getting cheaper and cheaper. In the price to sales ratio, we can see that the sales growth of the company has been outperforming the price. So we can see a downtrend here. Okay, so that means that as I said, the revenue of the company has been growing more than the price of the company. So the company was getting cheaper in the beginning of 2018, and now, as the same of the other ratios, we can see a plunge here where the price to sales ratio falls below 1. That means that we only have to invest 71 cents to get $1 of the company sales. Same here with the price to book ratio, and this tells us how much the company book value we're gonna get if the company is sold off in pieces. Okay, so here we get $1 of the book value of the company for every 64 cents we invest in. So a healthy value would be below 2 also. Okay, so this is the 2 level, and we are here. So this is value. Okay, so after reviewing all the ratios in this group, we surely can give a valuation a 5-star rating. Now we're going to move forward to management ratios. And the first one we're going to analyze is the shareholders' equity. And we can see here how the shareholders' equity has been growing steadily since 2016. Here we can see that the price has been outperforming the shareholders' equity here. And that could be for too much optimism over the market or the sector or the industry or even the company. Then we can see here that the price started to underperform the shareholders' equity while it was steadily growing. Okay, so again, as the price plunged here, we can see that the shareholders' equity is almost twofold the total market cap of the company, total value of the company. Now in return on assets, we can see how the assets of the company has been growing over time on a percentage basis. And we can see that the percentage of growth has been growing since early 2015. Then and late 2018 has been going south a little bit. Okay, from 7.5% on return on assets to 6.75. Okay, at the beginning of 2020. In the other hand, we can see how the return on equity has been growing steadily during in the last 5 years. Okay, we can see that it started off on early 2015 at less of 10% of ROE, and then nowadays it's on 70.06%. Okay, that is a very good sign that the shareholders' equity will be growing and growing over time. Okay, now another important metric to look at is the debt to equity ratio. And as we can see in this chart, the debt to equity ratio has been growing since the beginning of 2018, and it dropped since the middle of 2019 to the beginning of 2020. Okay, but we can see that we have an uptrend here. So this might be disadvantages, especially in this market environment that we are going through right now, market conditions, sorry, that we are going through right now, because now the company has to issue more debt to fulfill their obligations because it's out of business right now for the quarantine. And as we can see in the next chart, in the next image, sorry, we can see that the credit rating has downgraded to Baa3 in Moody's rating from Baa2. That means that the company, the further debt that the company is going to issue is going to have more interest rate. So that means that they're going to have to give up more profit in order to fulfill their obligations with the bondholders. Okay, so we're gonna give management ratios a 3-star rating. Okay, and now we're gonna move on to the technical analysis, and now we're gonna see what the market is doing with this stock. So now we're gonna start with the weekly chart to have an overall outlook of the price, and we can see that the price right now bounced back from those important minimums here in 2010, 2011 and 2012, and then the price moved up, making new highs. And then during this quarantine, the price touched this minimum level again and bounced back. So that means that this resistance is a great buying level. Now we're going to give a further look into the daily chart, and we can see here that the price, let's change color, the price has hit the 23% Fibonacci level, and that means that the downtrend is still very strong, but we still have really near this minimum level, so the price is kind of tied up in this, between this level that tells us that the downtrend is still strong, and this minimum level that tells us that the price could bounce back to make new highs. Now in the intraday chart, the hourly chart, we can see on very detail that the price has been doing a divergence compared to the RSI, while it was hitting this historical minimum. Okay, so we can see a bullish divergence here, then the price bounced back up and made a new high, then goes back again to this resistance and then bounce back again. We can also see that the price has done kind of a double bottom, that is a bullish pattern, but for a bearish point of view, we can consider this, let me clean this up, we can consider this a triangle pattern, that is a continuation on the downtrend. But on the bullish side, we are still in this historical minimum that the price couldn't break down in 2010, 2011 and 2012. So this is a very strong resistance here. So now in our intraday chart, I pointed out the low risk buying levels in this stock. These levels are $26.38 and $22.93 respectively. Okay, here and here. Okay, here's how you can trade them. You can buy BL1, okay, and average up on BL2 if the price falls gently, and take profit in the short term, selling your position during the consolidation. Okay, you can sell, for example, here in this resistance, you can sell here, or you can expect the price to break up and make new highs if you're a long-term trader or a swing trader. So if you decide to stick to your bull position, here's how much return you can expect from this trade. So if you buy at BL1 here, you can make up to 409.9% on your money, return on your money. Okay, and buying back again at BL2 here, you can make a 490.7 return on investment. That means if you invest $1,000 only in this stock, the potential gain could be up to $4,970, leaving you with an equity of $5,970. Okay, only expecting the price to go back to their original levels before the crisis. Okay, not going up, making new highs, just going back to their original levels. Now let's take a look at the competitors in the same sector. So as we can see, the leisure industry has been hitting hard during this crisis, and that opened up many opportunities in other stocks in the same sector, such as MGM Resorts and Norwegian Cruises, as we mentioned before. So in this last chart, we can see how this company has been performing all together, and how we can see the same buying opportunities that we have mentioned before. Again, we are talking about well-known companies, and that has been heated down for the irrational market behavior, and we as traders can take a huge advantage of this situation and make a huge profit out of it. So we're gonna give a 3-star rating to technical analysis, as we can saw that the downtrend is still strong, so it is probably that the price will remain at those levels as we mentioned before, but it's still a good buying opportunity. So we're gonna give 3 stars to technical analysis, and the final score is 4 stars. That means that it's a great opportunity to buy, always at the great levels when you can make the most of the money and less the risk. So to finish this video, before placing any trade, make sure that you can control the risk and put money on that you're fine to lose at least 50% of it, okay? And now, because always you have to remember, the markets can remain irrational more time than you can remain solvent. Okay, take care my dear traders, and see you in the next video.